Well, the month of May has been a mixed bag when it comes to the automotive sales. But what are these trends and what can we expect from numbers going forward? Before that, we are in conversation with Basudeb Banerjee. He is a research analyst with Antique Stock Broking, and he can take us through some of the trends that we can expect when it comes to the automobile sector. Basudeb, thank you for joining us. I'm going to start off with your analysis on what you've thought about Maruti's volumes for the month of May.
Yeah, so the volumes of few of the companies came out today. So I will say Maruti was lower than expected, especially the compact segment, which was lower by almost 7,000-8,000 compared to expectations, because Desire refresh got launched this month, and despite that it was lower. So it means models like Swift and Celerio must have done badly on a month-on-month basis. But a thing to watch out for is the retail volumes. We'll try to gauge that ASAP, because retail volumes are more important than wholesales. But if you look at other segments, mini segment wholesale of Maruti was pretty much robust. Same case with the Ertiga and Brezza segment. Exports anyhow are very much volatile for Maruti. So I'll say the only segment which disappointed was the compact segment, and primarily I think because of Swift. Other than that, the problem is stock has run up quite a lot in recent months. So expectations were quite high, anywhere between 1,45,000 to 1.5 lakh per month. So any number sub 1.4 lakh should have been taken as a disappointment, and that's why the stock corrected today.
Basudeb, if I were to talk about the passenger vehicles space as a whole, we are expecting numbers from Tata Motors passenger vehicles. We already have numbers from M&M's passenger vehicles as well, which has been a tad disappointing, just about a 3% growth. What can you expect from Tata Motors passenger vehicles, and how are you reading M&M's passenger vehicles?
Yeah, Tata Motors passenger vehicle definitely has been doing much better than their past track record, especially with Tiago Tigor and Hexa doing almost 1,000 units a month, and Tiago Tigor giving a boost. So for Tata Motors, from a stock perspective as an investor, whether they sell 5,000 units more or not, it hardly matters to the numbers. So even from a growth perspective, last year it was a very small base. These new launches, successful launches came out in between the year. So main thing to watch out for is absolute number per month. So ideally they should be crossing 14,000-15,000 odd numbers soon. So that's the number. But ideally passenger car volume for Tata Motors has any bearing for the stock price. Yes, the medium and heavy commercial vehicle segment MHCVs last month was much on the lower side, because being of the first month under BS4. And this month also one should not expect any miracle, especially if you look at Leyland numbers. They were also down year on year. SML Isuzu numbers were also on the weaker side. So I won't be surprised to see Tata Motor MHCV numbers to be sub 10,000 this month again.
So Basudeb, my next question will come down to the expectations on the performance of commercial vehicles, not just for the next few months, but perhaps for the next couple of quarters. Can we expect an uptick?
See, commercial vehicle demand depends on primarily gross fixed capital formation of the economy and the industrial production growth. If you see overall capex cycle in India, almost 4-5 years, there has been no signs of capex cycle. Your credit growth by the banking industry is mid-single digit, and despite low interest rates and low fuel prices. So this signifies the ground level demand of road freight. If you look at the demand drivers in the form of cement sector or steel sector, the industry growth is barely double digit. So if you combine all these things, and also the capital cost of trucks having moved up because of metal inflation, BS4 transition, so the fleet owners are not seeing a very profitable proposition at current juncture, as freight rates are also not that lucrative. So leave aside next few months where anyhow GST transition, BS4 transition, volume should not be that great on a high base of last year. But even from a full year perspective, at best a 5% growth, if not in the negative side for this fiscal.
So Basudeb, if I leave the performance of Royal Enfield out, the past quarter has seen a subdued performance for the other two-wheeler space. Again, can we expect a recovery there?
See, as you know, their Vallam phase 1 facility will come up somewhere in August. Until then, their capacity constraint will limit their monthly volumes around the 60,000, 61,000. So in Q4 also, they peaked their production with similar monthly volumes of 60 odd thousand. So Q1 volume over Q4 won't be much of a difference. The only thing is margin with further efficient vendor management, some softening in metal prices. They can manage to improve their margin, but at least from a next quarter perspective, Royal Enfield is going to remain at these levels. But the good part is beyond next 1 or 2 quarters, I will say that there was a phase that Royal Enfield used to be selling at a waiting period of 3 months plus. That came down to as low as 15-20 days. Now for 6 continuous months, 6 months or 8 months from January to August, if you are selling under capacity constraint, that demand across the dealer outlets and the waiting period automatically should start improving again, because the footfalls have improved, but your retailing did not increase. So ideally, post-August, when the new capacity comes on stream, there won't be any problem in absorption of the incremental capacity, and the growth momentum should again restart post this new capacity comes up. So we expect Royal Enfield to touch almost 1 million units in FY19, which means a monthly run rate of around 82,000. Present run rate is 60,000. So incremental capacity from Vallabh is of a similar quantum. So demand-wise, there is no issue. People who are buying those 60-70,000 rupee on-road bikes, they are moving towards through their aspiration and affordability to this 1.5 lakh segment. So largely it is that 125cc segment gradually moving up towards this 350cc models.
And one final sector that I want to, or rather segment that I want to address, is the agricultural equipment segment. And we have seen a considerable uptick, not just for Escorts, but also for Mahindra and Mahindra. Can we expect this trend to continue as well for these two companies?
You mean the UV portfolio of Mahindra? See, Mahindra is a great company, has been there in the market for decades, and were one of the pioneers of the utility vehicle concept in India. Your Sumo came, your Qualis came, your Innova came. But the problem is that if you see per month volume of Mahindra UV portfolio, used to be 20,000 even 3-4 years back. And now even today it is of similar quantum, despite multiple new launches in between. And you can't expect Scorpio and Bolero to drive growth for you for more than a decade. So largely Scorpio and Bolero are showing signs of saturation or low growth, and even with this duty increase on hybrid vehicles, a part of Scorpio will see almost 15% price hike. That should have a impact on Scorpio demand. But the unfortunate part was not that kind of success for KUV and TUV. Management is pretty much confident that those brands will start reviving back. It will be great to see KUV see success down the line. But the main problem is if you see new launches in the form of Brezza, Creta, even a costlier model like Innova Krista, these kind of models are getting very well accepted by the market, and there is a demand pull for these markets. People will aspire to own a Creta. But the kind of models in the form of KUV, as per channel checks, the young generation which was targeted for this model, hardly there is any pull factor for those models. So with experienced management, experienced R&D team, design team in the form of Pininfarina and SsangYong collaboration, they definitely have the ability to come out with such successful models, and we hope that Mahindra will come out with some such model where the taste of the market is similar to a Creta, I will say. But definitely that's not going to happen in next 12 months. It's a matter of time when they will launch that kind of model and will pick up market share again. Because if you see, Mahindra has lost their market share in overall UV market quite a bit, from 50 odd percent around 4 years back, now towards around between 25 to 30%. And Maruti in that time frame, just post launch of Ertiga, has moved up all the way to 25% plus through Ertiga and Brezza now.
Made all the auto stocks that you track, Basudeb, beg your pardon, which stocks do you think have the most return potential from current market levels?
See, as an investor, one will always look at the compounding proposition of the business and not from a 6 month return angle. So we stick to our thesis from that side, and going by the visibility of demand. Our topics are Eicher Motors and Maruti. Eicher Motors sheerly because of Royal Enfield and the visibility of 1 million units of FY19 and a 34% EBITDA margin. That gives us the visibility of being positive on that, and a 20% volume compounding beyond that is highly achievable. So that uncertainty part in Royal Enfield is much lesser than other players who are dependent on good or bad rainfall, good or bad, I will say, economic cycle. Royal Enfield is very much insulated from those kind of volatilities. And second thing is Maruti, going under capacity constraint. All the new launches are having 2 to 3 months of waiting period. So if you see in your portfolio per month volume, 10,000 Baleno, 10,000 Brezza, and new Desire will also deliver somewhere around 10,000. So almost 30,000, which is 20% of your overall portfolio, is having 3 months of waiting period. So what more you need to have visibility for incremental growth, where the mini segment is stagnant. New Swift will come out next year. So the mid-segment portfolio and low-end portfolio is pretty much stagnant. The incremental growth is taken care of by these new launches having 3 months of waiting period. So that gives us the visibility of 12 to 14% volume CAGR for Maruti. And if you do that, and assuming currency scenario remains static and raw mat basket remains static, 16% kind of EBITDA margin is highly achievable. And that gives us the visibility for Maruti earnings. And that's why in this kind of market, visibility gets respected with higher earnings multiple.
Thank you for taking us through some of those pointers. Thank you for joining us. It was a pleasure speaking with you.